welcome back to another episode of the Know Your Numbers REI podcast. Your host, Chris McCormack. Honored to be bringing this to you. We've covered a lot in recent episodes, and we're not going to stop anytime soon. So today, we're going to be talking specifically about a tax strategy that is often referenced, and people are like, you can do this and just do it this way, and it ends up, as with most strategies that get abused, it ends up causing more problems than it solves. So we're going to get rid of the gray area that has been projected out there in the market waves and just give you some solid ground to stand on. Recently, we've been doing some current event stuff as well as just goal setting stuff. Today, we're going to be getting into more tax strategies. So I hope this is valuable to you. If you do get value, feel free and go ahead and share it with a friend. You can also subscribe, whether it's on Spotify, Apple, YouTube. We'd love to have you staying tuned in to all of our latest updates. YouTube and Instagram gets the most updates, regularly posting short form content as well as the long form podcast. So that's where you'll get the most, but Spotify and Apple gets the long form content. And I totally understand that some people like to listen to podcasts while doing other things as well, but can't hurt to subscribe to them all and just stay fully up to date. So today, like I said, getting into some of the strategies when it makes sense to hire your children. Yes, believe it or not, you can hire your children, and most people do believe it, but they don't know where to begin or how to do it. So we're going to be clearing the smoke out of this one. My biggest concern for you, the listener, is that you find this strategy online and then you run with it on your own. The IRS regularly closes the door on strategies that are not applied correctly. And it is often because somebody like you found a strategy online. They think it's verified because the person projecting it is either wealthy or appears to be wealthy. Maybe they say they have a CPA or they're a tax planner. And so why not run with it? That will not fly in the IRS. You are responsible for the burden of proof. And as with any strategies that we talk about here on the Know Your Numbers podcast, it is pertinent, that means very important, for you to have somebody in your corner that is trusted, that will get in line with some of these strategies that we'll talk about and will point you in the right direction. And so if you do not have that, feel free to reach out to us. We're taking on new clients this year, only a limited number of people that we work with. So reach out sooner rather than later, and we'd love to see if we have a good fit for you. So again, remember that this is a strategy that can be abused, but hopefully these pieces will make sense to you and point you in the right direction. And then you can get somebody, whether it's me or someone else, to foot the bill, if you will, and sign off on it and get you saving thousands and thousands of dollars, because this can save you thousands and thousands of dollars. If you are in tax year 2025 and you apply this properly and you check all the boxes and you get it done to the best possible situation, you can save your family over $3,000. It's more like $3,500. And depending on the tax bracket that you're in, it could be as high as $5,000, maybe even $6,000 of taxes that you will save by applying this strategy properly. But there are things that you need to be aware of and need to make sure that you do correctly so as not to open the door to unnecessary audit risk, unnecessary liability, which ends up resulting in interest and penalties and taxes being paid. So the first thing that we'll talk about is the age requirement. So as somebody who is familiar with the tax law, as well as court cases that come into the tax law, and this is not all because of my doing, I surround myself with some strong and vetted professionals, one of which is the network of American Institute Certified Tax Planners. That's where I get the certified tax planning designation. And every year we have to go through advanced continuing education, more than what is required for the CPA. These are specific to tax planning. And one of the things that we do in those continuing education is talk about some of the court cases that have been passed and some of the things that we should be aware of. And one of them is this hiring of the children. There are age requirements. As far as I know, the youngest age requirement is 7 years old. And so even at 7 years old, you're going to want to make sure that you have your ducks in a row and that you're doing it in line with what the IRS requires. At any age, you're going to want to make sure that's the case. But if you're paying your 3-year-old to pose for advertising pictures and promote those pictures through the use of advertising and paying them $15,000 for their work, that will not fly. Because the IRS and really the tax courts have told us that 7 years old is the youngest that you can do it, anything less than that, they'll automatically throw away because there is prior case that they'll refer to as being what somebody is available to do. And then even when you are older than 7 years, the work has to meet specific requirements. So it has to be work that is actually beneficial to your business, and it has to be work that you would also pay somebody else to be doing. And that will also take us into the wage requirements. So there's age requirements, there's work requirements, and there's wage requirements. Age requirements, 7 years old is the youngest that you can do. Work requirements, it has to be reasonable work. It can't be like drawing pictures of logos on a piece of paper when you know in the back of your head that your 7-year-old's not going to come up with your logo, right? Let's talk about things in the real estate side, right? They can be maintaining your properties. They can be raking leaves, mowing lawns, shoveling driveways, and you can be paying them for that work to be done. They can be helping around as you repair or renovate your properties. They can be involving themselves in the masterminding or the business discussions. These are certain things that they can be doing. I think back to a time when I was working for my dad. Again, he's an entrepreneur himself, has a law practice over in Hartford, Connecticut, or just outside Hartford, Connecticut. And when I was in the high school age range, there were times during winter breaks that I would go and work for him. And what we would do is we would file papers, shred papers that no longer needed to be around because we uploaded them to the cloud. So you can have them scan files, you can have them shred paper, you can have them file paper, you can have them organize your building, your office, what have you. These are all certain work opportunities that they can participate in that you can then pay for them, so long as they're 7 years or older. Wage requirements. It has to be a reasonable wage. You can't just pay them $15,000 for posing for one picture in advertising. You have to pay them a certain amount that you would also pay somebody similar, right? It's like this reasonable salary. There's something known as reasonable salary when it comes to your S corporation. You have to pay yourself a reasonable salary that is going to line up with what you would expect somebody in your position to be paid at a similar business in order to fly in the face of an audit. And this is the same. It has to be a reasonable salary for somebody who's raking leaves, for somebody who's plowing driveways, for somebody who's mowing lawns, for somebody who's filing paper. So it can't be $15,000 an hour. You work 1 hour and you get $15,000. That would be great, but it's not going to fly, right? In order to get to that $15,000 mark, we have to actually pay our children a reasonable amount. They have to work for that amount, and it has to add up to that amount. So those are some of the requirements. Other things to keep in mind when it comes to just best practices. Contracts are big. You want to make sure that you have a contract in place. This is a great way to teach your kids, hey, this is what happens when you get a job or when you start a business and you engage in a shared service with somebody else. You want to make sure that you have a contract in place, and then you can educate them on what a contract is. And now they're getting business law courses at home, and college level courses are being provided to them at home at a young age. It is a great opportunity to educate them, to teach them the value of hard work, to teach them the possibilities of entrepreneurships and business ownership and real estate investing. Okay, so these are things they want to do. Make sure contracts are in place. Make sure that you're paying them a salary and that you're taking certain taxes out of it. So if the reason I say $15,000 is because that is the standard deduction level. And so if it is $15,000 or less, because that's a standard deduction level, that means that any income you make within that $0 to $15,000 is not taxable, because the deduction will just remove it from your taxable income. Anything more than that will be taxable. So you want to stay in line with that. Granted, you can still pay them more than that, but they will be responsible for taxes. You'll have to file a tax return for them. If they're older than 16, they're responsible for Social Security and Medicare taxes, the employment taxes. And so that's something that you want to be aware of. And so you do want to pay them a salary. You don't have to withhold taxes from that salary if it's going to be less than $15,000, but you want to get them on the payroll and run that payroll so that it can be shown that it actually is a business endeavor that you're taking part in. Other best practices, timesheets, making sure that they're recording time, especially if you're paying them an hourly amount. It's important that you have timesheets to back up what you're paying them for. Clear responsibilities, that's done in the contract. The hourly rate that you're paying them. Those are some of the best practices. Things to avoid as you're hiring your kids. Paying large lump sums. Again, this $15,000 mark, you could hear it on an Instagram reel or a TikTok reel or a YouTube reel, or see it on a Facebook or LinkedIn post and say, okay, great, I'm going to pay my kids $15,000, get the write-off, and it's all said and done, clean as ever. No, that's not the case. Avoid the lump sums, avoid the large lump sums. Again, timesheets and regular payroll are helpful when it comes to checking the necessary boxes that the IRS looks for. You want to make sure that it's going into a separate account. Your name can still be on the account, but their name needs to be on the account. It needs to show that it was going from one hand to the other. And then you can still have custody over that dollar. So you can still say, hey, son or daughter, here's what we're going to do with this money. We're going to invest it in a Roth IRA. We're going to put it towards your summer camp. We're going to do this and that. You can put some money and use it because you worked hard for it, but we're going to set you up for success by setting up a Roth IRA or a cash value life insurance account or something of the like that will positively impact their financial future. Another thing to avoid, and I kind of touched upon this, would be advertising or using them for advertising purposes. So we've had people come to us. I can't imagine they just came up with this idea. I imagine they heard it from somebody, whether it's in a networking group or on Instagram or somewhere else. And it's like, just put your kid down and take pictures of them and call it advertising and pay them for advertising. That's not going to fly. Again, age requirements, work requirement, wage requirements. Now, if you're paying your kid to post signs for your flipping business or your wholesaling business, that's great. You should definitely be doing that. And that's a form of advertisement that can qualify as a business related expense. But if the sole purpose is that you just got a photo shoot that you're going to use for business purposes, that's not going to fly, especially if they're less than 7 years of age. So these are some of the important things to think about when you're hiring your children. Again, not an exhaustive list. You're going to want to consult a tax professional. If you run into a tax professional that's like, yeah, we don't want anything to do with that, find a new tax professional. This is a vetted strategy. Again, the IRS or the tax courts have said older than 7 years old, you can go ahead with it. So it is a great opportunity. It can save you thousands of dollars in taxes, but you want to make sure that you're doing it properly. Again, the burden of proof falls on you. And so if you're not following along with these and some of the other things that the courts and the IRS have put in place for us to follow, then you're going to be swimming upstream. You're going to be drowning in legal fees and interest and penalties and unpaid taxes, and that's not what we want. So we want to get it right from the start, get you set up, save you taxes, get your kids set up for a good financial future, and it all comes by hiring your kids and doing it correctly. Until next time, God bless you and keep moving forward.